If you held Rocket Lab blocks through June, you just absorbed a ton of pain. The tape completely round-tripped its May momentum, crashing over 30% from its local peak. Chasers called it dead, but it just surged 20% in 48 hours. Let's check the tape. Rocket Lab closed Monday, up a heavy 15.93% at $98.01. Wiping out half a month's losses in 2 sessions is total roller coaster price action. But that's the reality of high beta growth proxies this year. If you are front-running secular aerospace expansions, AI infrastructure, and microcap tech rotations, smash the like button and subscribe. Share your target price below. Can Rocket Lab reclaim its structural highs or contest its SpaceX? Why the sudden violent short squeeze? Rocket Lab just dropped an absolute nuclear catalyst, an $8 billion mega acquisition of global satellite comms titan Iridium. This is a historic commercial M&A deal that has the street buzzing. For those unfamiliar with the target spreadsheet, Iridium operates a massive LEO satellite network servicing 2.5 million active users across deep tech verticals, including sovereign militaries, commercial aviation, and maritime shipping. Look at the structural pivot. RKLB used to be a pure-play launch operator building vehicles for third parties. Post-merger, it transforms into a vertically integrated powerhouse that builds, launches, and operates its own subscription network. Smart money is looking at this saying, wait, this script is identical to SpaceX. Exactly. You build the heavy launch infrastructure, deploy your own constellations, and collect high-margin monthly recurring revenue. Rocket Lab is copying the Alpha blueprint. So why did it bleed 30% in June? Simple. The highly anticipated SpaceX IPO drained the sector's liquidity pool. Institutional funds dumped smaller satellite tickers to fund SpaceX allocations, prompting a massive technical drawdown. But this 48-hour recovery indicates that big money is aggressively repricing RKLB. They realize it's no longer just a rocket line. It's a space utility compounder with immediate free cash flow and a mature enterprise backlog via Iridium. Granted, the credit desks have valid questions. An $8 billion buyout is heavy, requiring a $3.6 billion bridge loan structured by Deutsche Bank and Wells Fargo. Near-term debt issuance and equity dilution risks will keep volatility elevated. Mechanically, the June liquidation successfully flushed out the levered retail tourists. This violent bounce is institutional block capital rushing back into the space. However, clearing structural macro resistance depends on full merger integration. Sell-side consensus models on Bloomberg maintain an aggressive target spread spanning a $60 floor to a $135 ceiling, averaging $112. While consensus indicates structural upside, Wall Street is highly divided between a bull breakout and an M and a risk. Space infrastructure assets are pure plays on multi-decade forward terminal value, but trading desks operate strictly on near-term quarterly execution metrics. Tickers like Rocket Lab are engineered for wild delta swings. It's the growth equity tax. Let's test your framework. If you had to deploy a major growth allocation into the order book right now, would you rather accumulate high multiple SpaceX equity or buy Rocket Lab on this M&A catalyst? Drop your thesis below. Subscribe and hit the notification bell if this structural analysis gave you an edge. For our exact entry clusters, trailing stops, and private community desk access, check out the links in the description below. See you on the next tape.